Welcome back to Smart Stock Sam, the channel where we cut through the hype, ignore the noise, and hand you the cold, hard data you need to make smarter, more confident decisions. I am your host, and today we are going deep on Datavault AI, ticker symbol DVLT. This is a full analyst-grade briefing covering brand new patents, a live real-world deployment at the NFL Draft, a massive GPU rollout, and the exact price levels you absolutely need to have on your radar this coming week. Stay locked in all the way to the end, because by the time we are done here, you will understand exactly why this battleground stock has every serious trader in the room holding their breath and waiting for the first domino to fall. Let us start with the raw price reality, because the numbers here are almost uncomfortable to look at. As of April 25, 2026, DVLT is trading at just 72 cents and 97 hundredths of a cent per share. It is down slightly on the daily. But here is where the math becomes genuinely wild. Equity analysts have set a consensus price target of $3 flat. That is an implied gain of 310% from where we are sitting right now. But, and this is a massive caveat, the market friction is extreme. Short interest has surged to 22.90% of the total float. That translates to 81.1 million shares trapped inside what I can only describe as a pressure cooker environment. While the growth trajectory looks incredible on paper, there is one hidden structural metric that explains precisely why the price has not already launched into orbit and left the short scrambling. We are going to unpack that in just a moment. But first, we need to talk about the violent tug-of-war that played out right here in April, because the chart is telling a story that most people have completely missed. April has been a genuine roller coaster for everyone holding a position in DVLT. On April 16th, the stock spiked all the way to 85 cents when the company activated its very first quantum-ready edge GPU sites, a tangible, operational proof point that this is not just a press release business. Then, on April 22nd, another 5.5% single-day jump came roaring in on news of a significant new patent issuance. The upside momentum felt unstoppable. But then, look at what happened on April 23rd. And this is where things got genuinely complicated. Management announced a $50 million deal to acquire a stake in a company called Vivasource. Now, on the surface, an acquisition should read as a bullish signal, right? But because this deal was structured entirely as an all-stock transaction, it forced the issuance of 75.9 million brand new common shares into the market. The moment investors saw that incoming dilution on the horizon, they sold the news immediately, even as the company was simultaneously running a live platform deployment at the NFL Draft. Think about that for a second. Two massive positive operational catalysts, patent approval and a high-profile event deployment, buried under the market's reaction to share dilution. That tension right there is the entire story of this stock in the current moment. But why would management dilute shareholders so aggressively in the first place? It is all about constructing what strategists call a defensive moat, and the one DVLT is building right now is unlike anything else in this sector. Here is the part of this story that separates serious, long-term investors from the noise traders who flip on headlines. Datavault AI is not simply slapping the word artificial intelligence onto a press release and calling it a tech company. They are attempting to engineer a structural monopoly on the compliance infrastructure of digital asset taxation. Their newly issued patent, number 12,596,819, directly targets IRS Form 1099-DA. Now, if you have ever traded cryptocurrency, NFTs, or any form of tokenized digital asset, you already know that the tax reporting side of that experience is an absolute nightmare. DVLT has built an automated pipeline that takes raw digital asset transaction data, applies artificial intelligence to value every transaction, and generates the required IRS tax forms completely automatically. They are securing ownership of the infrastructure layer of institutional compliance before the United States government begins its full-scale enforcement cycle on digital assets. And here is the strategic reality of the technology world. Whoever holds the patent on the compliance standard almost always ends up owning the market that compliance creates. Could this patent quietly become the backbone of every single crypto tax filing processed in America over the next decade? That question alone is worth your undivided attention. Now let us put real numbers on the operational momentum, because this is where the story shifts from speculative thesis to potentially transformational business. In Q1 of 2026 alone, Datavault secured $750 million in tokenization contracts. From that growing pipeline, the company has already generated $77 million in direct platform fees. Management is holding firm on a $200 million revenue target for the full calendar year of 2026. Here is the single most crucial number every smart investor needs to track going forward. How fast can Datavault convert that $77 million fee pipeline into audited, recognized revenue on a real balance sheet? That is the inflection point. That is the moment when institutional sentiment flips from skepticism to conviction. If they hit that $200 million mark by year-end, the current sub-dollar share price will look like a historical anomaly that people reference for years. But here at Smart Stock Sam, we never let the bull case run unchallenged, because the financial picture has two completely opposite faces staring back at you simultaneously, and you need to understand both before you make any decision. On the bull side, you have that 310% upside target, a strengthening patent portfolio, expanding GPU infrastructure, and live operational deployments at high-profile events. The profile of a tech giant in its early compounding phase, but the bear case is screaming just as loudly and deserves equal respect. The net profit margin sits at negative 202%. They are losing significant money in the pursuit of hypergrowth. Layer on top of that the 75.9 million share dilution from the Vivasource deal, combined with the fact that the stock is trading well below its 200-day moving average of $1.20, and you can see the full picture of why the market has punished this name so aggressively. DVLT is paying a steep price for its high-conviction capitalization strategy. Now let us look at the ownership structure, because who actually holds these shares creates a uniquely explosive setup in either direction. This is a retail-dominated stock through and through. Institutional ownership, the big banks, hedge funds, pension allocators, sits at a near invisible 0.66% of shares outstanding. While Vanguard and State Street hold small token positions, the near total absence of sticky institutional capital makes DVLT exceptionally vulnerable to sentiment swings and organized short attacks. However, and this is a genuinely important counterbalance, the insiders are completely locked in. On April 20th, the CEO and CFO received significant share grants that do not even begin to vest until September of 2026. Their entire financial outcome is anchored to long-term execution of the business plan. That kind of skin in the game matters when evaluating management credibility. Now let us check what the charts are actually telling us about the next move, because technically, this stock is sitting in a very recognizable and decision-forcing pattern. DVLT is currently in a prolonged consolidation phase, carrying a clear bearish bias on the daily time frame. The relative strength index is sitting at 50.17, complete no man's land, neither overbought nor oversold, which typically signals that a decisive directional move is building beneath the surface. The MACD is printing at negative 0.01, generating a structural sell signal. But here is the silver lining buried inside all of that technical pressure. The price is currently hugging the 50-day moving average at 71 cents, using it as a floor and testing whether there is enough accumulated energy for a meaningful bounce. And that potential bounce is precisely what the short sellers are sitting up at night worrying about. Remember those 81 million shares short? They are currently trapped inside an expensive maintenance cycle, paying annual borrowing fees that can run as high as 25%. That is an enormous and grinding carrying cost for every day the trade does not work in their favor. With a days-to-cover ratio of 3.28, these short positions cannot be unwound instantly, even when the pain becomes unbearable. So what is the actual squeeze trigger that could turn this from a grind into a vertical move? If trading volume spikes above 60 million shares in a single session and the price decisively clears 85 cents, those short positions face forced covering, all at once, with no organized exit available. That is precisely the mechanism by which a microcap stock goes parabolic in a matter of hours. Is it possible that the 81 million shares of short interest become the very fuel that launches this stock to its analyst target? The math says yes, if the catalysts line up. Analysts believe the market is currently mispricing DVLT by approximately $2.27 per share. Closing that gap and reaching the $3 consensus target requires a fundamental shift in how the investment community evaluates this name, moving from demanding immediate profitability to assessing execution quality on the roadmap. That roadmap has three specific and observable checkpoints. First, the market must fully absorb and digest the dilution from the Vivasource deal without violating the 70-cent structural support floor. Second, in Q3 of 2026, the full commercial rollout of the 48,000 GPU fleet must go live. This is the high-performance computing backbone upon which the entire revenue model ultimately depends. Third, by December 31st, that $77 million fee pipeline needs to materialize as audited revenue on a certified financial statement. If all three of those milestones execute in sequence, the analyst community's current hold ratings almost certainly get revised upward to buys, and that is when institutional money begins paying attention. Let us get tactical now, because the week ahead has specific price levels that define the entire trade. For the window of April 27th through May 1st, the tactical map is simple and clear. Your floor and stop-loss anchor is at 70 cents, aligned with the 50-day moving average and validated as a consolidation base. On the upside, you are managing two key resistance walls, 77 cents, which capped the rally following the patent news, and the critical 85-cent breakout level that triggered the spike on GPU activation day. Your buy-the-dip accumulation zone sits between 70 and 72 cents. If price runs to 85 cents and gets rejected on low volume, you take gains and wait for the next setup. But if volume explodes past 60 million shares and price closes above 85 cents on confirmed momentum, you hold your position. That is the squeeze trigger. The midterm technical target for that move is $1 even, which also happens to be the psychological compliance threshold the company needs to satisfy NASDAQ listing requirements. Two independent catalysts converging on the exact same price level is a setup worth respecting. The final verdict on Datavault AI is this: DVLT is a high-risk, high-reward speculative asset with a clearly binary outcome. The daily technical charts are a strong sell given the dilution overhang and the deeply negative operating margins. A hard 70-cent stop-loss is non-negotiable if you are in this trade. But the expanding IP moat, the live operational momentum, and the massive unrecognized revenue pipeline create genuine asymmetric upside if that 85-cent breakout triggers with real volume behind it. The stance is speculative hold. Entries belong near 70 cents, daily noise belongs in the background, and those 2026 execution milestones belong front and center in your tracking calendar. Before the final wrap, an important financial disclaimer that Smart Stock Sam takes seriously. Everything discussed in this video is for educational and informational purposes only. Nothing here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. Always perform your own independent due diligence, consult a licensed financial professional, and never allocate capital you cannot afford to lose entirely. Microcap and penny stock equities carry extreme volatility risk, and past data never guarantees future performance. Now here is the question I genuinely want you to wrestle with in the comments section below. And the smart stock. Sam community always brings the sharpest thinking on this. Do you believe DVLT can hit that $200 million revenue target by year-end and the 48,000 GPU fleet achieves full commercial deployment in Q3 without further dilution? Drop your real answer below. Your perspective genuinely helps everyone here think more clearly. If this breakdown gave you value today, please hit the like button right now. It is the single most powerful way to help this channel reach more serious investors who deserve this level of analysis. If you are not yet subscribed to Smart Stock Sam, click that button and ring the notification bell. We cover high-conviction, high-stakes setups like this every single week. And if you want to directly fuel the independent work we do here, YouTube's Super Thanks feature is sitting right below this video. Every contribution keeps this channel free from sponsored bias and driven purely by data. I will see you in the next one when we find out whether the squeeze actually triggers. Stay smart out there.